we're talking about, well, we've been talking about direct materials variances, right? Which can be either we paid more or less than the standard, or we used more or less than the standard, right? The price and usage variances. In standard costing system, all these inventories are carried at the standard, right? And the price variance is computed at point of purchase, and unfavorable variances are debits, favorable are credits. So the way I remember it is unfavorable variances decrease net income. So they're like an expense. So they're debits. Favorable variances are always credits. So, it's kind of like income increasing. That's how I remember credits. That's what increases them. All right. So here's how you do it. This is your journal entry. When you purchase direct materials, assuming an unfavorable price variance, you debit your materials, debit your price variance, and credit accounts payable the liability. And we do an example like this in problem 9.30. So if you want to review journal entries, go to 9.30, the very last part of the problem. And here's direct materials price and uses variances. You issue it, so it's going to work in process, right? So you are debiting work in process because that's an inventory, which is an asset. This variance is unfavorable, so it's a debit. This needs to be over here. This is a credit. So that's a mistake on the slide. Sorry about that. So let's talk about labor variances. All right. Labor variances, again, you have rate. You pay your labor a certain amount hourly, and efficiency, it should take a certain amount of time to make your cost object, right? So it takes, I think it was 1/100th of an hour to make yogurt, if I recall. So direct labor and efficiency variances. Same thing. We have these formulas to compute the direct labor variance. And you've got your labor rate variance, which is going to be your actual rate times your actual hours, right? And your standard rate times your actual hours, or algebra, AR minus SR times AH. Same thing. Exactly the same thing. All right. So once you apply that, you know where you got off in terms of your rates, right? Because we've basically, we have stripped out hours, and now we're just looking, okay, what's the difference in rates? Same thing with efficiency. Did they use more hours than they should have? Another formula, actual hours minus standard hours times standard wage rate. So the standard wage rate is the same for both actual and standard. So now we can figure out, okay, well, where's the difference would be the efficiency then, because there's no difference in the rate. The rate's the same applied to both, so the difference has to be in the efficiency. And what do you do to post those guys? Well, favorables are going to be credits, and efficiency and unfavorables are going to be debits. That's the same thing. Nothing is any different there. So to move your labor into work in process, right? So just like everything, we take direct materials, direct labor, direct labor and overhead, and move them into work in process. All right. So once we do that, we've increased that work in process. It's an inventory, so it's an asset. So you increase work in process with a debit. And of course, the credit for work in process is wages payable. Your variances right here This would be an income decreasing variance. So an unfavorable, if you had an unfavorable variance, either for efficiency or labor, it's going to be a debit. If you have a favorable variance, either for efficiency or rate, it's going to be a credit. All right. And of course, if you do have variances, something went wrong, right? You'd expect a little bit of random things. You know, if you have a labor efficiency variance and it took more hours than normal, what's going on there? Was somebody gone that day, so you had fewer people on the line? Did a machine break down so they couldn't work for a while? You know, you just need to look at that and figure out what's going on. The variances for direct material and direct labor get close to cost of goods sold. If they're immaterial. But in this class, we're going to assume that you're pretty good at estimating, so your variances are not going to be material. And this should not say materials, because all your variances get close to cost of goods sold. If you have a material variance, and it cannot necessarily be for materials, it could be for direct labor, it could be for overhead, it's going to get close to cost of goods sold. So, right, because we want to zero out, those are temporary. Variance accounts are accounted for, but they're temporary accounts, so we have to close them before the next period. So that's what's going on there. So you close them out. Let's talk about overhead variances on the next video. So we've done direct materials, we've done direct labor, but you can be off on overhead too when you're using standards.